Hi ladies and gentlemen, this is Game of Trades, and in this video I'm going to explain to you why I am currently keeping a large amount of cash in today's market. So with the longest bull market in history, with 11 years of non-stop grinding since the bottom in 2009, we are seeing what looks like to be a high level of greed in the markets right now with clear parabolic moves. Now, this can be considered as a bullish breakout by some, and this can be considered bearish, indicating that the market is going too far, too quickly by others. In fact, if we take a look at the fear and greed index, you'll quickly notice we are close to extreme greed levels over at 92. The famous advice: buy when there is fear and sell when there is greed. Now we know that the market is going to see downside at some point in the future. We just don't know when. All we can do is speculate and guess, and frankly, investing based on a guess is nothing other than gambling. Now the question to answer in this video is, as an investor, how do I invest in the S&P 500 without knowing what is going to happen in the near future, without knowing whether this is a real deal breakout or whether this is a parabolic move leading to a potential bubble pop and a huge come down in price. Now, before I get into the actual video, I will ask you to please drop a like on this video. It does help a tremendous amount to try and show my channel to more people on YouTube. Now, many people have the misconception that the S&P 500 is extremely safe, and that no matter when you invest and what you invest, you will end up making money at some point. Now, obviously, this is true considering we are making all-time highs. No matter when in history you invested, you would be making gains right now. That is the definition of an all-time high. The problem with the S&P 500 is that you can often end up investing and having dead money for multiple years that really could be better invested somewhere else. And just going back recently, I can highlight some of those moments for you leading up to the dot-com crash. If you had invested any moment between 1997 and 2000, this would have been dead money for multiple years. And same thing goes for the 2008 crash. Anyone that invested during this period of time would have had dead money for multiple years. Now, is this necessarily the end of the world? No, absolutely not. You do end up getting your returns back and end up making profit, but it is obviously not ideal to invest in at such times. Now, same thing goes for the 2014 to 2015. This would have been dead money, perhaps not for years, but definitely for a few months, which is, again, not ideal. And that's what happens when you have bearish signals like an MACD crossover in 2014. Same thing here, an almost MACD crossover in 2006. And same thing here in 1998, accompanied with multiple divergence from 1996 all the way to 2000, similar to what we're seeing now. Now, this does not necessarily mean that we will have some kind of a crash similar to the dot-com bubble, but this is definitely something to watch out for and definitely something to look at when investing in the S&P 500. These technicals are bearish. They can be turned around, burnt through. Divergence isn't a be-all, end-all, and can be burnt through, and the markets could potentially continue on like they did for multiple years between 1974 and 2000. That was a 20-year period where there was essentially very little risk in the market except for perhaps the 1987 flash crash. So the point is, times are uncertain. We do have multiple bearish signals, and going all into the S&P 500 with our portfolio right now isn't perhaps the wisest idea. Now, that said, I do not think that you should not at all be invested in the S&P 500. As I've said many times on my channel, I do see the potential scenario where we could come down to this level to backtest the all-time highs and then reverse and continue the bull market for many, many months, perhaps many, many years. And this would definitely be a good drop down zone to invest for the years to come. Very similarly, in fact, to the 2015 backtest you had seen here, many people thought the markets would eventually crash down back to the 2008 level right here, but we didn't. We broke the level and we backtested, and many people took the opportunity at this backtest and made a lot of profits on this Trump run. And this could be just a repeat of that situation, offering us an opportunity to ride the bull market further. So the point is, nobody really knows where the market is going. Are we going up for the next few years? Are we going to be in a bear market for the next few years? Who knows? What you can do is use a few simple strategies to try and make your investments as safe as possible. If you do keep cash and the market does end up having a long-term correction to the downside, you could use the cash that you've kept on the side to reinvest at price support levels or even Fibonacci retracement support levels such as these. And that would really effectively lower your average position and reduce the amount of dead money that you have, because if you invest right here as the market is going down, then your investment would not be dead money for a very long period of time. It would actually be a very good investment at a very good price for a lot of potential upside in the future. Now, when I do say keep cash, I obviously don't mean necessarily cash per se. It could mean different diversified liquid assets, meaning that you can easily sell them to reinvest in the S&P 500 in case we do see a correction. Now, in the case where you do invest right here with cash on the side and the S&P 500 does start going higher and grinding higher and higher as the weeks pass, then ideally you would want to see these bearish technicals start to fade away for these MACD divergences and RSI divergences on the monthly chart to actually be burnt through, just like they were burnt through during this period of time. We did have divergence, you can see right here. We did have divergence right here, but as the months passed, the divergence was clearly burnt through. In fact, the MACD really started going to much, much higher levels in the years leading to the 2000. Now, another very interesting way to invest in a long-term position in the S&P 500 is to do it just like you would trade it. And I know there's a lot of traders on this channel, so you'll know exactly what I'm talking about when I'm saying put a stop loss on your investment. This is a breakout, and if this is a good breakout, this could potentially be the bottom for many, many years to come. However, if it is a false breakout, you would see downside in the coming weeks. And if you have a stop loss, let's say right below, effectively have a very, very safe investment position in the S&P 500 with very limited downside and a lot of potential upside. Now, obviously, in the case where you do hold the S&P 500 for a very long period of time, you'll want these bearish technicals to start and fade and start to be burnt through, just like they were in let's say 1987, where you did have a lot of bearish technicals, but they were eventually burnt through and a lot of gains was eventually made in the stock market. Now, the last thing I want to mention in this video is the compatibility of this type of long-term bullish investment with an actual trading strategy to the short side. And I know many of you in the comment section were often criticize me for highlighting potential corrections in the markets. You can have a short position in the S&P 500 all while still being invested in the long term. One does not necessarily exclude the other. Now, I know this is simple investing education, but I really wanted to make sure my subscribers have a full grasp of this concept before they decide to go either long or short in the market. Now, I hope you guys enjoyed this video. If you did, don't hesitate to drop a like. It does help me out a tremendous amount. Subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.